Have you seen the news? Binance, OKX, Kraken. One by one, major crypto exchanges are showing privacy coins the door. Giant red delisted stamps are appearing over logos like Monero and Zcash. What in the world is going on? Is this the end of financial anonymity in crypto? Stick around because we're about to unpack the entire story, from regulatory crackdowns to the surprising future of private transactions. It feels like a coordinated attack, doesn't it? One day you can trade XMR freely, the next it's gone from your favorite platform. This isn't just a random decision by a few companies. It's a direct response to a massive wave of global regulatory pressure. We're seeing a clear trend sweeping across the globe. Let's start with Europe. The European Union has rolled out its Markets in Crypto Assets Regulation, or MiCA. This comprehensive framework is designed to bring order to the crypto Wild West, but it comes with a strict condition: traceability. MiCA mandates that crypto service providers must be able to track transactions to combat money laundering. And what's the one thing privacy coins are designed to prevent? Exactly that, traceability. Their core feature, anonymity, puts them in direct conflict with these new rules. Then you look at other major financial hubs. The United Arab Emirates, which has been positioning itself as a crypto-friendly region, has also banned anonymity-enhanced cryptocurrencies. The same story is unfolding in places like South Korea and Japan, where regulators have long been wary of coins that obscure the flow of funds. The message from governments is becoming crystal clear. If you want to operate in our jurisdiction, you need to play by our rules, and our rules demand transparency. For privacy coins, this is an existential threat. These aren't just isolated incidents. It's a global regulatory domino effect, and centralized exchanges are caught right in the middle. So why this intense focus on privacy coins? The heart of the issue boils down to two conflicting ideals: the crypto world's love for anonymity versus the traditional financial system's absolute requirement for compliance. Regulators are primarily concerned with two acronyms, which stands for anti-money laundering, and CFT, which means combating the financing of terrorism. For decades, governments have built a system to track the flow of money to prevent illicit activities. Think about it. Every time you make a large bank transfer, it gets flagged and reported. This system is designed to catch everything from tax evasion to funding criminal enterprises. Now, enter privacy coins. Monero, for example, uses technologies like ring signatures and stealth addresses to make it virtually impossible to trace the sender, receiver, or amount of a transaction. For advocates of financial privacy, this is a beautiful true digital cash that mimics the untraceable nature of physical currency. However, from a regulator's perspective, this is a nightmare. They see a black box, a potential tool for the dark web, enabling untraceable payments for illegal goods and services, or for laundering money from criminal activities. While most users of privacy coins are likely not criminals, the potential for misuse is what drives the regulatory crackdown. The technology itself creates a direct clash with the legal frameworks that govern our financial world, and that's a battle that's proving incredibly difficult for privacy coins to win in the mainstream arena. This puts centralized exchanges in an impossible position. Imagine you're the CEO of a major exchange like Binance or OKX. You operate in dozens of countries, each with its own set of financial regulations. Your business relies on maintaining banking relationships, securing licenses, and serving millions of mainstream users who expect a safe and legal platform. On one hand, you have a user base that values choice and access to a wide variety of assets, including privacy coins. On the other hand, you have regulators breathing down your neck, threatening to revoke your license or hit you with massive fines if you do uncomply with their AML and CFT laws. What do? It becomes a simple business decision, a matter of survival. The volume and revenue generated by privacy coins, while significant to their communities, are often just a small fraction of the exchange's total business. Compared to giants like Bitcoin and Ethereum, they are a niche market. So, the exchange faces a choice: risk their entire operation for a small percentage of their trading volume, or make a sacrifice to ensure long-term stability and compliance. They choose compliance. They sacrifice the privacy coins to protect the rest of their business and maintain their licenses. It's not that they necessarily have anything against privacy. It's that they cannot afford to be on the wrong side of the law. Delisting becomes the path of least resistance, a way to appease regulators and ensure the company can continue to operate and serve the vast majority of its customers. So, what has been the real-world impact of these delistings? The most immediate effect is a hit to liquidity. When a major exchange delists a coin like Monero or Zcash, a huge pool of buyers and sellers disappears overnight. You can see it in the charts. The trading volume on centralized exchanges for these coins takes a nosedive. This can lead to increased price volatility and makes it harder for people to buy or sell large amounts without significantly impacting the price. For the average holder, it means their assets are suddenly less accessible and potentially less valuable in the short term. But here's where the story gets interesting. Is this the death knell for privacy coins? Not necessarily. This pressure from the centralized world is forcing the privacy coin ecosystem to evolve. We're seeing a significant shift in activity towards decentralized exchanges, or DEXs. On platforms like BISC or Atomic Swap Services, there's no central company to pressure, no single entity that can be forced to delist a coin. These are peer-to-peer systems that connect buyers and sellers directly. While they may be less user-friendly than a slick centralized app, they are censorship-resistant. This regulatory crackdown is, in a way, pushing privacy coins back to their philosophical roots, decentralization. The community is actively developing new ways to trade and use these coins outside the reach of traditional financial controls. So, while the bridge to the mainstream financial world is being burned, a new, more resilient, and truly decentralized ecosystem is being forged in the fire. This brings us to the big question. What is the future of financial privacy? This isn't just about a few niche cryptocurrencies. It's a fundamental debate about our rights in a digital age. Do we have a right to private transactions, or should every single financial move we make be transparent and traceable for the sake of security and regulation? There are strong arguments on both sides. Proponents of privacy argue that financial surveillance can be a tool for control and oppression, and that privacy is essential for a free society. Opponents argue that complete anonymity is a recipe for chaos, enabling crime and undermining the rule of law. The delisting of privacy coins from centralized exchanges isn't the end of the story, it's just the end of a chapter. It marks the point where the mainstream, regulated crypto world and the decentralized, privacy-focused crypto world are diverging. One will be fully regulated, transparent, and integrated with traditional banking, think CBDCs and compliant stablecoins. The other will be a more underground, decentralized ecosystem where privacy is paramount, powered by DEXs and privacy-native technologies. This won't be the end of privacy coins. Instead, it has a push that forces them to become what they were always meant to be, a truly independent and censorship-resistant alternative. The question for you is, which system will you choose to be a part of? Thank you so much for watching. This is a complex and evolving topic, and I'd love to hear your thoughts in the comments below. Do you think the delistings are justified, or is it an overreach of regulatory power? Don't forget to like this video and subscribe for more deep dives into the world of crypto. See you in the next one.